One mistake cost me over $5,000 in my first year of trading options. That moment and others like it taught me lessons that I still use 6 years later, and that took my results from inconsistent and frustrating to a reliable second income source. So in this video, I'm going to show you the biggest mistakes that I made and that you're probably making as well, exactly how I fixed them, and the strategies that I now rely on. So you can skip the pain that I went through and start building supplemental income trading things like the wheel. So first, I'll show you the mistake I made before I even placed my first trade. And it all has to do with how I approached trading as a way of making some extra cash. Because when I got started in this whole crazy world, a mentor once told me, the problem with trading is that the kind of people who are attracted to trading tend to make the worst traders. And what he meant by that is the allure of a lot of this, you know, the dopamine spikes, the flying green and red candles all around the screen, numbers constantly moving. If that's what excites you and that's what gets you going, you probably shouldn't do this. And I was that person. And so this even predates when I started taking this seriously. Pre-2019, I was always trying to make big money quickly. I was suckered in by the promise of giant returns, overnight riches. And you very quickly get humbled if that's your approach. And there's this also illusion of the best. What is the best? Because there's always going to be someone with faster access to data, for example. As an individual, you are not going to compete with hedge funds if you play the same game. And there's going to be more on that later on. There's going to be people with insider knowledge, which, you know, is illegal if we're doing stocks, but it does happen. There's going to be people with a higher risk tolerance. More on that later on as well. And there's also going to be people with less experience than you, but the benefit of naivete. And so, you know, this still affects me to this day because in 2023, I did 33.8% return. And, you know, that's pretty good, right? But I deal with inadequacy at times because I've seen others produce double that number. I've seen some people claim, and I'm sure some people did do it, they may triple that number. But knowing what I know about options and the wheel specifically, if you did 100% in 2023, either you didn't trade it in 2022 or you made massive losses then and you've chosen to ignore that. And so my focus has always been, I don't want to be the best in any given year. I'm not trying to shoot for astronomical returns. I just want above average returns that I can maintain for the longest period of time. Not trying to do 80% in a year, then minus 80% the next. But if I can average high teens, low 20s annualized returns for 20 years, it's going to make me a very wealthy person. And I'm going to be delighted with that. And you've got to have reasonable expectations as well. And it really is what works for you. For example, if you get 12% annualized, and that's enough for you, then those results are perfect for you. And this is why I'm so pro investing as an individual, because you only have to answer to yourselves. You don't have to answer to outside investors. You don't have to produce monthly and quarterly returns to please shareholders. It makes it so much simpler. And by walking your own path, you can also learn at your own pace. So that's lesson number one. Lesson number two, every single strategy works. Now that sounds very counterintuitive, but allow me to unpack it. The truth is, even bad strategies can make money in the right conditions. The rising tide lifting all boats is, you know, a decent part of returns from everything, but it also amplifies bad strategies. If you traded crypto in 2021, it was very difficult in the year 2021 to not make money. You know, not being said people who made bad decisions as to what they did with that money, but in 2021, it was almost impossible not to make money if you were involved in crypto. Other strategies may work for some people, but not for others. For example, you know, I know a lot of people like scalping. For me, I don't want the constant screen time. I don't want to be beholden to every single day, Monday to Friday, I have to be on Tasty Trade at 9:30 Eastern, ready to act. I want more flexibility in my life than that. And to be honest, I don't want the ruthless emotional discipline that a strategy like that requires. Because I like to use the 3 R's approach when it comes to a successful long-term strategy. Rewards, in other words, what kind of returns are you going to get? Risk tolerance, we can talk through things like volatility, drawdowns, stress levels, and also routine. How is it going to fit into your routine and your life? And so there is no best strategy. There's only the best strategy for you. And, I've traded, buying long calls out of the money, hoping that earnings plays work out. I've done credit spreads, debit spreads, calendar spreads, iron butterflies, iron condors. And for me, what I do now, and this is really 98% of my trading, is selling cash secured puts and selling covered calls, which is the wheel. That is the best strategy for me because it gives me solid returns, generally between 15 and 30% annualized. Last couple of years has been really, really good, but I don't think I'm going to maintain low 30% returns annualized over the next 20 years. Low stress, because, I've got a family. I don't want to be staring at my brokerage account 8-9 hours a day, and a relatively low time commitment. This takes me 4 to 5 hours per week. It allows me to run the business. It allows me to spend time with my family, and it really just fits into my life and my routine. So that's the strategy I've settled on. And I've even got a nice visual for you here. Sell a put option. If you get assigned, you sell a covered call option. Get assigned, you sell the stock, hopefully at a profit. More videos about that as well. And that's really the wheel. Anyway, lesson number 3, you must have an edge. Got to have an edge, otherwise you're just gambling. This is one of the ones I had to learn the hard way. Without an edge, you are just gambling, except you're not using casino chips, you're using ticker symbols. When I was just buying out of the money call options on stocks that I thought would go up, or sometimes not even stocks I thought would go up, stocks someone else told me were going to go up, I didn't have an edge there. Time was against me. To be honest, I didn't really know the ticker symbols I was even trading, and I was just throwing money away. I think everyone should read the Market Wizard series by Jack Schwager, because throughout the series of 4 books, the first one and the most recent are my 2 personal favorites. These traders who have done so well in so many different trading disciplines, they win with all different kinds of strategies. And the how-to advice in those books contradicts each other a lot of the time. If you read the first book, they all talk about, it's literally every other chapter they flip-flop. One guy says RSI, Relative Strength Index, is a really useful tool. Another says it's completely useless. Another swears by Bollinger Bands. The other says it's completely useless. Others swear by moving average convergence. Others say it's completely useless. And it's so funny, they all disagree with each other. But every single one of them, these successful traders, they all have an edge. Now, I've got to say some edges no longer exist. It's not 1904, we're not Jesse Livermore here. You can't just get a better price because someone in one city hasn't heard the news yet. It doesn't work that way. Also, you're not going to be faster at executions than everyone else. You've got hedge funds, you've got high frequency trading firms. All of these firms have algorithms that work faster than any human. So you're not going to be able to out-execute them, especially not as an individual. So trying to compete in the same arena isn't worth it. Same goes like right now, I'm pretty certain there's going to be a crypto bull run in the next 12 months. And I really hope people don't fumble the bag, so to speak, by trying to trade against kids who spend 16 hours a day in a Telegram channel, who have zero downside because they haven't got rent to pay, they haven't got a mortgage, they haven't got bills. So they can afford to YOLO all their cash on these obscure meme coins that are probably pump and dump schemes. But if you're in your 40s and 50s and you're trying to do this while providing for a family, nah, you're playing the wrong game. So you need to know where your edge lies. And for me, My favorite type of edge, and this is why I like the wheel, it's a 1-2 punch. I can always rely on time, because when you're selling options, time is always in your favor, because options, all other things being equal, decline in value over time. So you sell high and you buy low. I like strategies where time is on my side because I'm fairly competent when it comes to technical analysis, but I'm certainly not the best technical analyst in the world. I don't have 100% certainty what a stock's going to do tomorrow, but I do have 100% certainty on the sun coming up and the market opening on Monday and option prices, all things being equal, being slightly lower. The two part of the 1-2 punch is my opponent. Who's on the other side of the trade? I don't want to be on the other side of the trade to hedge funds or quant traders. I want to compete against the guy who's had a few drinks and thinks he's the next Michael Burry and he's shorting every stock in sight. So he's buying puts on all of these companies. He's convinced everything's going to fall apart and I'm selling the puts. That's the kind of opponent that I want. I want to be the casino. I don't want to be the gambler. So that's my favorite type of edge. Lesson number 4, and this is so important, and this is another one I learned the hard way. You gotta understand probabilities. Now, one of the most misleading metrics when it comes to people talking about trading or trading strategies is this thing here, win rate. Win rate means absolutely nothing without additional context. And you see these companies, they advertise this stuff all the time. For example, this gentleman here, in 2020, when the market crashed, I had an 87% win rate. During the bear market in 2021, and by the way, what bear market? 2021 was phenomenal. What are you talking about? But, I'll take it at face value. During the bear market in 2021, I had a 70% win rate. Last year, I had an almost perfect 95% win rate. So he's like, oh, I've got this amazing strategy. It's incredible. Look at the win rate. Win rate doesn't tell you anything, once again, without additional context. First of all, what's the return? If you've got a strategy that has a 99% win rate, but it only generates 2% annual returns, I mean, it's garbage, it's crap. Same goes for risk reward. I can sell today a 1-day deep out of the money put on the SPY. And I guarantee that's like a 99.9% win rate trade. But it also means I've got to lock up $57,000 in collateral to make $7 before commissions. So that's not worth it even with an astronomically high win rate. Because once again, the rewards aren't there. And the other part of this is when people talk about things like adjustments and stop losses and profit targets on trades. And this is how I really know that someone has no clue what they're doing. And when I got started, I would just follow advice like this at face value. People would say like, okay, you buy the stock at $10 and all you need to do is set your stop loss at $8 and you take profit at $15 because what you're doing is you're only risking $2, but you can make $5. So risk reward is in your favor. And that's advice that sounds quite sound on the surface, but it's actually terrible advice because it very, very falsely assumes a 50% chance of either scenario happening. You've got your stop loss at $8 and your take profit at $15, and it assumes there's a 50-50 chance of either one of those scenarios playing out. But what you need to do instead is calculate the actual probabilities. And if you don't know how to do this, you should follow strategies where a lot of the probabilities are calculated for you within the strategy itself. Using things like delta as a proxy for what's the rough percentage chance this option finishes in the money or out of the money. So that's once again why I like something like the wheel, because I'm not there sitting calculating stop loss and take profit probabilities every 10 minutes. So you got to understand probabilities because that really helps you understand, okay, what's a realistic rate of return for a strategy like this? And so when someone tells you, oh yeah, you can do 100% every year doing the wheel, like That's not true. That's simply not possible. And yeah, someone's going to type in the comments, I did 100% in 2023. Do it over a 10-year period and then come back to me. If you can, I'll give you all my money. I'll invest with you tomorrow. By the way, if you do trade options, I'm not affiliated with this website, but I use it all the time. Optionstrat.com, it's completely free. You can see how options prices move in relation to stock prices and time in the trade. I use it all the time. We use it with students all the time as well, just to get them to visualize that if the trade goes against you in the first few days, it's not the end of the world. And like I said, the website's free. It's fantastic. Not affiliated with them at all. Optionstrat.com. Lesson number 5. Your strategy will go through a stress test. I don't care who you are. You will go through a period where you are not making great returns. There's no strategy which works 100% of the time perfectly in all market conditions. If there were, we'd have found it already and we'd only use that one. If you've seen the movie Pi, which is one of my favorite movies, by the way, the guy spends all of his time trying to crack the code to the stock market, and he thinks he's done it at one point. And then he goes insane and he ends up giving himself a frontal lobotomy. Now, the true test of a strategy is how it performs and how you react during periods where the results are not perfect. When I first started, I would search high and low for ways to make every single trade a winner. I would do these ridiculous adjustments, tweaking things on a daily or sometimes an hourly basis, which just make things worse. Because all of this tweaking, it's mental energy. A lot of the times I'm actually like putting on more trades as adjustments, paying more commissions for worse results. So here's the deal. You lose more money deviating from a certain strategy and trying to learn new ones on the fly than you do by sticking to a winning strategy even during tough times. Now, case in point, once again, these are my own results. I made 8%, not 80, not 18, 8% trading the wheel in 2022. God bless energy stocks, I tell you. Because if it wasn't for them, 2022 would have been a lot worse. Could I have made more money if I'd have just shorted the entire NASDAQ or done SQQQ, which is an inverted leveraged ETF? Yes, I could have done that. Would that have meant I then thought I was a genius and got destroyed when the market recovered? Also, yes, I would have probably blown up my account. What 2022 really represented for me was the stress test of doing the wheel. Then when the conditions improved as 2023 rolled around, so did my results. And it was only through building up experience through the stress test that I made tweaks and iterations to my process and my strategy that serve me to this day. So when things like the yen carry trade blow up in August of this year, when that happened, I had a process to deal with it. I didn't have to panic and learn something new on the fly because I understood how my trades were going to react to something like that. And one of the major iterations that I do and I did, or I did and I do, is really just like a look at how I take profits on my trades. Now, I always take profits based on a mathematical formula. It is completely systematic. There is no discretion involved. And I don't have time to go through the entire formula in this video. I may make another video on it. But in essence, it is a balance of the percentage of the total profitability of a trade captured so far in relation to the amount of time remaining in said trade. Now, this serves me extremely well because, first of all, it's systematic. I never have to worry about winning trades going against me. And trust me, there's nothing worse than, you've captured 90% of the upside on a particular trade. You're waiting for the last 10% to kick in. You're waiting for that one last leg up or those few days to pass by, and suddenly the trade starts going against you. You're handing back all your profits. There is no worse feeling than that. And what it also does is it allows me to rinse and repeat the same trade again and again and again to retake advantage of time value. Most importantly of all, from a mental perspective, it also makes the process a lot easier to manage. because you don't have to think about everything. It's all done for you, and it's all done based on math, not emotions, not gut feeling, not what you had for breakfast that day. Which also leads me on to number 6. More is not always better. Oh, yes, my dabble with iron condors. In late 2019, I started doing iron condors a lot more. If you don't know what an iron condor is, basically you sell 2 calls and 2 puts simultaneously, creating a safe zone in which your stock price can stay between, with an additional buffer where you buy options so you don't lose the full amount. Now, I've done some credit spreads in the past and I was fairly confident in my approach. And I thought iron condors, they're sort of marketed as more advanced. It makes them a natural evolution to bigger returns because of the buffer that you don't have with credit spreads. What it actually led to is I just spent a lot more time watching my trades, a lot more time staring at stock prices, and a lot more time doing adjustments that I didn't need to, unnecessarily worrying all the time, and really, I spent more time for less returns, which is a terrible, terrible strategy. Lesson number 7, and this is kind of a departure from the rest of this, who you listen to. I've even spelled pessimist wrong there. Pessimists always sound smarter than optimists. Robert Kiyosaki wrote Rich Dad Poor Dad, seminal work on personal finance. He also happens to be the king of doom mongering. There's a stock market crash coming every 6 months, according to Robert Kiyosaki. We need to sell all our stocks, put everything in gold. He's into Bitcoin now as well. But he's called 16 of the last 2 market crashes. We've got Mr. Hedge Fund legend, Whitney Tilson, who apparently can predict every major market crash, often to the exact day. Now, realistically, if you could do that, you would be a multi-billionaire. You'd probably be the richest person alive, and you wouldn't be selling a newsletter on how to do it. And there's always a reason not to invest. I've got reasons for the past 25 years. Dot-com bubble, 9/11, Iraq war, debt ceiling crisis, global financial crisis, Eurozone crisis, bond yields spiking, Russia invading Ukraine, North Korea, trade wars, COVID, inflation, regional banking, AI bubble. There's always a reason not to do it. There's always a reason not to do it. The financial media are always going to tell you that a crash is around the corner. Works the same on YouTube as well. Which videos get the most views? The one with people doing this in the thumbnail and a burning building behind them and sell everything as the caption. I mean, this is a psychological thing. Pessimism always sounds smart. As humans, we are pre-programmed to avoid losses more than we are gain seekers. It was part of our evolutionary biology. It's how we survived over thousands of years. Naturally, we pay a lot more attention to negative news. And the other thing is, it's easy to sit on the sidelines and have no skin in the game and just say stuff that sounds vaguely intelligent, like the market's too risky right now. Everything's overvalued right now. It's the easiest thing to say and have people like nod in agreement. Oh, everything's overvalued. Oh yeah, everything's overvalued. Yeah, absolutely. Or there's always an indicator that indicates everything's overvalued, market's going to crash tomorrow. There's always one. You can do this all the time. It requires no skin in the game. You can make yourself sound very smart, but it's very difficult to make money without skin in the game. There's also studies on this. Negativity drives online news consumption. If you're wondering why all of these YouTubers and the financial media focus on the negative all the time, it's because it gets the clicks. At the very bottom here, it says, for a headline of average length, each additional negative word increased the click-through rate by 2.3%. So yeah, if you're wondering why everyone has a burning building in the thumbnail with sell everything now, that's why. There's always going to be doubters. There's always going to be people who have a quote-unquote better approach, people who make more money than you, sort of goes back to the first lesson. People who say, oh, you shouldn't buy Tesla, you should sell it. Or you shouldn't be selling options on Nvidia, you should be buying them. What about when the stock goes down? Yes, stocks go down as well as up. I am aware of that. And yeah, maybe some do get better returns, but for the majority of people, it is merely a coping mechanism because they are sitting on the sideline doing nothing. My approach has always focused on data-driven optimism, not blind optimism, that's silly. Data-driven optimism. What are the charts saying? What are the fundamentals saying? What's the VIX saying? What are the premiums saying? What's the implied volatility saying? It's all data-driven. There are always good stocks to trade if you look at the data. In 2022, the market was garbage. Everything was down except energy. Energy as a sector was up 31%. So guess what I did in 2022? While everything else was burning, I traded some energy stocks. Were the premiums great? No, they were mostly garbage. But, hey, came out of the year 8% up. So I'm happy with that. And guess what? When the conditions aren't to my liking, I don't trade. Simple as that. Data-driven optimism. This has served me so well. And lesson number 8, which is the final one, but probably the most important one of all. It is an infinite game. Now, I'm a long-suffering Newcastle United fan. So those of you who accuse me of being fair weather, just because we've got a bit of money now, I was there when we got relegated in 2009. We lost 6-1 to Leyton Orient in a pre-season game. I was there. So don't you accuse me of being fair weather. In 2023, we had our biggest game of the past 25 years. We got to the League Cup final against Man United. We lost 2-0. Why am I telling you this? What does this have to do with trading? It's a finite game. Both varieties of football, the kicky one and the throwy one. Ends after 90 minutes. You move on. Your emotional reaction to that is limited to a set period afterwards. Trading, on the other hand, is an infinite game. There's no end. This then becomes an issue if you start internalizing your emotions around trading and investing. If you start to conflate a bad trade with being a bad trader, problems start coming up. If you allow things outside of your control to affect your process, this is when problems start compounding. One of the most important lessons that I've learned is that losses are part of the game. They're inevitable, but they're only harmful if you don't learn from them. Once again, this is an infinite game. If you've got a strategy that works, don't deviate from it. I've lost more money chasing hot trends and deviating from my process than I have sticking to it. I almost blew up my entire account. In 2020, I had the genius idea to short Netflix. The only reason I didn't is because I couldn't find a broker who would actually let me short the stock. For some reason, I was really fixated on shorting the stock instead of just buying puts. I was like, I'm going to short Netflix. I'm going to be a genius. The growth numbers have been accelerated by the pandemic. And I was right, but my timeline was completely wrong. So I would have blown up my account. But it was just silly things like that. Like, why on earth am I obsessed with shorting stocks now? Because maybe some of the stuff I'm going to talk about on this slide. The big picture. No single trade, winning or losing, defines who you are. Everyone should read What I Learned Losing $1 Million by Jim Paul for more on that concept. One of the most important skills that I've learned, and it comes with running a business as well, is you have to treat your trading account like a business. You know, you have a routine. I place 90% of my trades between 5 and 6 p.m. UK time, which is 12 to 1 p.m. Eastern, because that's just where it sort of fits into my day. You've got to track your performance. Imagine running a business and you didn't know your P&Ls. You didn't know your profit and loss. You didn't know how much money you were making. But people trade without actually understanding how much money they're making. It's insane. You have to understand that there are costs, commissions, FX fees, but losses as well. Losses are a cost. They are part of the game. And you also got to understand that some years are going to be better than others. It's not a one-way upward trajectory where you just make more money every year. And don't make important decisions when you're under emotional stress. 2020 was a very tough year for a lot of us, myself included. And so looking back in hindsight, you know, this Netflix theory I had, was mainly because I was at least 2 of these 4, if not 3 or 4 of them at any given time. So don't make any important trading decisions when you're under emotional stress. Hungry, angry, lonely, tired. HALT. Great acronym. The other missing piece around this is having people who are in the same boat is massively important. Trading and investing is fundamentally a pretty lonely discipline. For the most part, your family and friends probably don't care too much. If they do, you're really lucky. But community is so vital, and it's a big part of why I started this company and why we do what we do at Freeman Publications. You know, in our community every single day, we have people posting their wins, sharing questions, helping each other out. But we've got people from all kinds of backgrounds, from all over the world. I think it's 45 countries now, which is insane to me to say that out loud. But we're all working towards a common goal, which is just bettering our own financial situation. So it's been a huge blessing to be involved in that and to be part of this and running this for the last couple of years. So if you're interested in learning more about that, there is a link down below. You can have a chat with myself. If that's something you're interested in, if you've been trading the wheel or you want to learn more about what it takes to trade the wheel and yeah, make a bit of extra money on the side in not too much time, 4 or 5 hours a week, then that's what you can do. But I hope you enjoyed this video. I hope you learned some of the lessons that I've learned, and I will see you in the next one. So take care.